Money is a part of everyday life. We earn it, save it, spend it, and invest it. Yet the mechanics behind the modern monetary system often go unnoticed. Beneath the surface lies a system built on debt, inflation, and recurring crises, one that deeply influences how wealth is distributed worldwide. Modern money is no longer tied to tangible assets. Instead, it is created through debt. When a bank issues a loan, it doesn't use existing money, it creates new money. For instance, a $10,000 deposit allows the bank to keep 10% as reserves and loan out the remaining $9,000. That $9,000 might be deposited into another bank, which then lends out 90% of that amount. This cycle repeats, multiplying the initial deposit into significantly larger sums. While this process supports economic growth, it also introduces vulnerabilities. If debt grows faster than the economy can sustain, the system begins to show cracks. The 2008 financial crisis exemplifies this debt-driven model. Housing loans packaged into complex financial products inflated a massive debt bubble. When borrowers couldn't repay, the bubble burst, triggering a global economic meltdown. Millions lost their jobs, and economies around the world faced years of recovery. This pattern isn't unique to that crisis. It is a recurring feature of the monetary system. Another key element is inflation, often seen as rising prices but more accurately understood as the declining value of money over time. In 1971, when the US abandoned the gold standard, the dollar became fiat currency, no longer backed by gold. This shift allowed for unlimited money printing, but also led to inflation. Gold prices surged from $35 an ounce to $800 by the 1980s. While those holding gold saw their wealth grow, the purchasing power of ordinary savers eroded. More recently, during the COVID-19 pandemic, governments injected trillions of dollars into the economy to stabilize markets. While effective in the short term, this resulted in significant inflation over time. Rising food and energy prices hit middle and low-income families hardest, while asset owners benefited from surging property and stock values. Inflation, as a result, exacerbates the wealth gap, disproportionately impacting different groups. The banking system itself relies heavily on public trust and the continuous flow of money. Yet history has shown how fragile this trust can be. During the Great Depression, fears of instability led to mass withdrawals, causing thousands of banks to collapse. The 2008 crisis once again exposed systemic weaknesses when high-risk debt overwhelmed the financial system. Today, emerging technologies such as cryptocurrency and decentralized finance, or DeFi, are beginning to challenge traditional banking structures, signaling potential shifts in the financial landscape. How can individuals navigate such a complex system? The first step is understanding. Learning how inflation, interest rates, and monetary policies work builds a foundation for making informed financial decisions. Diversifying assets is also critical, not relying solely on savings, but exploring investments in areas such as property, stocks, or emerging technologies. Maintaining cash liquidity ensures flexibility during unexpected events. Finally, staying informed about economic trends and financial innovations helps individuals adapt to changing circumstances. The modern monetary system has been a powerful engine of growth, but it comes with significant challenges. By understanding its mechanisms and effects, individuals can better prepare for its risks and opportunities. The evolution of money, from the gold standard to fiat currency and now to digital possibilities, reflects a story of adaptation, power and survival. Understanding money is the first step toward building a more resilient financial future.